Hello, good afternoon, everybody. So, I hope you're having a good afternoon. So, today's webinar basically it's the main things which every trader should understand. Leave alone the strategy. Having a good strategy without risk is nothing. So, we want to learn exactly how one can manage the risk during intraday trading. So, first of all, let's define what is intraday trading. If you have a trade which you expect to close before the end of the day, then that's known as an intraday trade. If you have a trade which is running during the day, but you expect that trade to expire when the day ends, then that is known as an intraday trade. So there are some intraday trades. Sometimes somebody may enter trade and then the trade runs maybe for a few minutes and then he gets out. That may be known as scalping. Sometimes somebody may enter trade, a trader may enter trade. The trade runs maybe for some few seconds and then they are out with profit. That is still known as scalping. But if you have a trade which you expect that trade to run for some hours, but must not overlap to the next day, then that's known as an intraday trade. But on the other side, if you have another trade which the trade will run maybe for 1 month, 2 months, some weeks, then those are known as position trading. So in this case, basically we're just going to learn how to manage your risk for intraday trading. That is, how can you manage your risk during intraday trading? So there are some things which most traders don't realize. If you're a new trader, maybe you may not understand this, that each and every pair has their own value. Each pair has a value. That is, each pair has a tick value. Let me show you that. Assuming you have something like this, you have this pair, this pair, this pair, all these pairs. All of them, each one of them have its own value. That is, each one of them have different tick values. What I mean by the word tick is the smallest move in the market. So if you look at this place here. This is gold. You can see that the number keeps changing. It keeps shifting. Sometimes it's 21, 46. So it keeps oscillating. Every slight move is known as a tick, and every tick has its own value, new value. So like in gold, assuming you're looking at Euro USD, the value per tick could be 10, could be maybe 12, or could be 8. If you look at this, the value per tick is also different. So you must understand that every move, for example, the move from this point up to this point, assuming this was 10 pips, assuming we had like this, how many pips? This is around 65 pips. The value of those 65 pips is not the same as the value of 65 pips on Euro USD. They are different. They are very, very, very different. So this is one thing you have to understand. Before we look into everything, you have to understand that each and every pair has different pip value. So in the price, the slightest move in the market is known as the tick. The total number of ticks within a candle gives us the volume of that candle. So we are not talking about volume now. We are focusing on the tick and tick value. If you look at this, it also has a different tick value. If you look at this, it also has a different tick value. So just a second, let's create maybe a small script, some small script which will be able to print for us on the screen the value per tick. That is the value of the tick value of a given pair. Just a second. Now let's see what that brings us. This is one of the most important strategies. It's the main thing in the forex market that everyone needs to understand. If you don't understand this and then you go ahead trading, you know very well that there's something missing. Tick. Just a second. Give me a second. I'm just typing like a small script which will be able to print for us on the screen. Comment. Just a second. Tick value. Tick value. Sorry. Give me a second. It should be up now. Okay, so this is what I'm referring to. Tick. Just a second. So look at this. This is USDJPY. I want you to look at the left upper side of the screen, which is here. The tick value of this symbol is actually $9. And if you compare the same, maybe let's look at Euro USD. The tick value is 10, and then the tick value is 10 also for USDCHF, 10.92. So also understand that this keeps changing. USD CAD, the tick value is 7. Then USDJPY, the tick value is 9. We have AUD USD, the tick value is 10. And then we have NZD USD, the tick value is still 10. Then we have USD CNH, the tick value is 1. And then let's look at gold, or maybe GBP MXN, the tick value is 0.4. We have gold AUD, the tick value is 50 USD, which means per tick, if your volume is 1, if you're using a standard lot size, the value per tick is 50 for you. The same thing with gold euro, USD MXN, tick value is 0.46. Then gold, the normal gold, tick value is 10. Silver AUD, tick value is 50. Then the normal silver tick value is 50. Let's look at these stocks. Tick value is 7. So Australian dollar, you can see that the tick value is different. So why are we focusing so much on the tick value? That's the question. When managing risk, this is one of the most important things you have to understand, that each and every asset has their own tick values. Do not just calculate risk blindly. You cannot say that because you are risking 10 on this symbol, you want to risk 10 on gold. Assuming maybe you have a balance of maybe 100 USD. Let's look at this account, this demo account. Let's see. Okay, we have a balance of how much? We have a balance of 8,000 USD. So you cannot be risking 7 on, or maybe assuming you're risking 100 USD, you cannot risk 100 USD on every pair, because this has to keep changing. Because each pair has their own tick values. You have to calculate the amount of risk based on the tick value of that given symbol. So whenever you're calculating the lot size, like in this case we're having several lot sizes, whenever you're calculating every lot size, they must be based on a given tick value. So they are the three most important things before you find the correct lot size. Do not just calculate lot size based on the amount of money you have. No, this must not be the case. Do not calculate the lot size based on the amount of balance you have. And also, do not calculate the lot size based on the amount of money you expect to get from the market. Do not do that. But calculate the lot size based on these three things. First, here, this is risk in USD. The first thing, the most important thing when you're calculating the lot size is calculate it based on the amount of risk you expect to be losing. So if you have maybe, assuming you have this amount, 8,000 USD in your account, and you want to risk maybe 100 USD. So that is the risk in USD. You want to risk only 100. It can be a percentage of the entire balance you're having, or a percentage of the free margin. So like in this case, you will calculate maybe you want 2% of the free margin, or you want to risk maybe 5% of the free margin, or you want to risk like 3% of the free margin, depending on the amount of balance you have. So the amount of free margin. So if your margin is big, 5% will be more. But if your margin is small, assuming you have 100 USD and you want to risk maybe 5%, then the 5% will just be $5. The next most important thing is risk in pips. So risk in pips is basically the amount of pips to the stop loss. So assuming you'll enter a buy at this point here, you expect to enter buy when the price hits this level here, and you want that if the price goes below this, the lower line, which is 1.15869, you step out of that trade. This is how many pips. To calculate the pips, use the crosshair, this one here. Then you look at the digit in the middle. We have, if you subtract the difference between 1.16261, 1.15869 from this point here, you look at the difference here. So you find the number in between. This is 392 pips. So that means that if you're risking maybe 5% of this amount, the stop loss should be around 392 pips. So these are the three most important. The first one is risk in USD. The next one is the number of pips you expect to be losing, you are risking. And the next thing is tick value. So tick value is basically this number here. You have to know that each and every pair has their own tick values. So how do you use these three? Assuming you now have, maybe you've calculated this, you've calculated the risk percent, risk in USD. You want to risk maybe 100 USD now, like that. And then from this 100, risk in pips, you are risking maybe 100 pips. In my case, 100 pips. If you write 100, that stands for just 10 pips, because these are 5 digits broker. We have this. So this is like a 100 pips. So the tick value of Euro USD, let's see. Tick value, just a second. Let's pull it up on the screen. Tick value is 10. Tick value is 10. Tick value is 10. So we want to see exactly how much this gives us. What's the correct lot size? If this is how much you want to risk like 100 USD. You're putting 10 pips at risk. How much is this based on the tick value? So the formula for calculating the lot size now, this is the formula. Do not forget it. Lots is equal to risk divided by risk in pips. Risk in pips, you multiply that by tick value. So this is the formula. Anytime you are calculating the lot size, this is one thing you have to understand. This is the formula you'll be using every time you want to calculate the risk for a given trade. Do not calculate the lot size based on the balance you have. Never calculate lot size based on the balance you have. And also never calculate lot size based on the amount of money you expect to get from a trade, because anything could happen. The market may move in the direction it wants to move. It will always do that. So whenever you enter any trade, just understand that entering any trade does not guarantee that because you have money, the trade will move your way. No. You must have a stop loss. That's the first and the most important thing. You must have a stop loss. You must calculate the correct lot size. You must know that each and every asset has their own tick value. Every symbol, however many they are, each one of them have their own tick value. Each one of them have their own tick value. So we've already established this. We established that on this side. You can see this has 7. Nikkei, this has 95. And then IBEX, this has 11. Hedge, Hong Kong Stocks Index, this has 12. Then you have this one also has 19. So the same way, Euro USD has 10. Almost fixed to 10. So this is the formula. This is the formula. Whenever you want to calculate the lot size, like the way you can see, I have different lot size here. This is 3. This is 1. This is like 0.01. This is 0.01. How I came up with this is you have to have the risk. Risk is basically the amount of money you expect to lose. Divide the risk, the amount of money you expect to lose, divide it by risk in pips times tick value. So risk in pips, like in this case, we have 100, then the tick value is 10. Then the amount in USD is actually 100. So you'll divide 100 divide by 100 times 10. That will give us the correct lot size. So which means if you now get maybe the lot size is 10 in this case, or maybe the lot size is 0.02, or whichever the lot size is, you enter the trade at that given lot size. You come here, maybe the lot size is 0.02, you enter a buy, drag the stop loss at 100 pips, 100, that's 100 pips is, should be below. So when you drag the stop loss at 100 pips, you will find that the stop loss is actually at 100 USD. So let's do that. We'll calculate that. Just a second. Let me pull up the calculator first so that you see that. Just a second. Let's see that calculator. Just a second. So I'll make my screen visible so that you're able to see my screen. So look at this. Now, if you want to calculate the loss size, we've said risk. It is risk. So the first thing we'd like to do is we want to multiply the number of risk in pips times tick value. That's the first thing. Then after that, we divide the value risk divide by the value which you found by multiplying these two. So we have 100 pips in pips times 10. This is 1000. So this is 1000. This is the result of multiplying risk in pips times tick value. We now want to divide risk in USD, divide by the value which we just found. So that is 100 divided by 1000. Sorry, 1000. We have 0.1. Okay, what that now means is if you want to risk 100 USD, you want to risk at least 10 pips. Your lot size should be 0.1. Does this make sense? So whenever you want to risk, assuming now somebody changes here, they say they want to risk maybe 50 pips. You are risking 50 pips, then you want those 50 pips to be only 100 USD. You do the same thing. You multiply 500 times 10. Yes, times 10. Then you divide 100 USD, divide by 5,000. So 100 divided by 5,000. 5,000. So this is 0.02. That means that if you want to risk 50 pips, if you're risking 50 pips, and you want price that if the price goes up to 50 pips, you should have risked 100 USD, then your volume should be this. So we'll try that. Let's pick a buy now. Then you drag our stop loss to 500. Then we see if that 500 is actually 100 USD. Let's look at that now. So we have just a second. We have 0.02. 0.02. We buy. Then we drag our stop loss. Let's see if that is true. Whatever we are saying. Okay, just a second. Let's see 500. 500. Okay, that is take profit. Then we drag here 500. here. So this is 500. Sorry, wait. I think we've done a mistake. This should be 50 because we're using a 5-digit spot. This should be 50 times 10. Sorry. Let's see, 50 times 10. 500. So 100 divided by 500 now. Sorry. 100 divided by 500. This gives us 0.2. That's the correct lot size. So that means, sorry, not 0.02, 0.2. 0.2 we buy. Then the stop loss is 500 pips, so we copy that. So are you seeing that we've actually risked around 100? I mean 100 USD. The profit is 103.403. The number of pips is 517. So basically, this is how you calculate the lot size. This is how you come up with the lot size. Do not calculate the lot size based on the amount of money you expect to be getting. That's, don't calculate the lot size based on the take profit. Calculate it based on the risk. How much you expect to be risking. If you expect to risk, you want to risk just $10, ensure that you know how many pips you want to risk. Maybe it's 10 pips. Use that one to calculate the correct lot size. If you don't do that, maybe you're trading a fixed lot size. You must be using an expert, not manually. But if you have to do this manually, understand that this is how you come up with the correct lot size. Normally, this is how you'll be able to calculate the correct lot size so that you're able to trade perfectly. At least it should help you, because all the strategies you're using are just 50% to 40% accurate. Whatever somebody tells you, every strategy is almost 40 to 50% accurate. The remaining 50% is actually the risk. How much you expect to be risking a trade, how much you play with your lot size. That's what makes up for the remaining 50%. So if even with the most accurate strategy, the highest it goes is maybe 60. The remaining amount, which now maybe adds it to 75%, is actually how well somebody calculates their risks. So what I can confidently say is, if you have a good strategy, you have 50% chance of being accurate, being successful. If you have a bad strategy, you still have 50% chance of being successful. If you want the chance for you to increase, chance of being successful to increase, attach that strategy to a proper risk management. You'll increase it by maybe 10%, 5%, or 2%. That will make you at 52, which is still okay. Is that clear? So this is basically how you calculate the risk. Do not calculate your risk based on something else, or based on the amount of money you expect to be getting, or based on the amount of money that you expect. Whatever the balance you're having. Calculate the amount of risk based on the value you expect to lose. So that should bring us to the end of today's session. We'll meet again next week at the same. So thank you. See you.